You can earn $250,000 a year and still get told you don't qualify for a home loan. You can have money rolling into your bank account every single month, steady as a clock, and still walk out of a lender's office with a declination letter. Declined. How does that happen? Because the system isn't measuring what you actually earn, it's measuring what you reported. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. And today we're going to talk about something that quietly costs smart, successful people their dream home every single week in this country. Your tax return might be the problem, not your income. Here's what most people don't understand about traditional mortgage qualification. When you apply for a standard loan, the lender looks at one of two things. If you're a W-2 employee, they look at your paycheck. Simple. If you're self-employed business owner, a 1099, if you're self-employed, a business owner, a 1099 earner, a commission professional, a contractor, a consultant, a real estate agent, a gig worker, they look at your tax return and not the top line. They look at your net income after every deduction your CPA helped you take. Now think about that for a second. Your accountant spent a year doing exactly what a good accountant is supposed to do. Write off the truck, write off the office, write off the meals, the travel, the equipment, the home office, the phone, legally, ethically, correctly. The goal was to reduce your tax bill, and it worked. Then you walked into a lender, and that same tax return says you made $60,000 last year, even though your bank account says you deposited $180,000, $200,000, $300,000, $400,000. Same person, same income, two completely different stories. Here's the line I want you to remember. The same strategy that saves you taxes can disqualify you from a home. If you control your income on paper, this applies to you. Business owners, real estate agent, loan officers, contractors, consultants, independent professionals, anyone with heavy write-offs. You did everything right. You built a business. You followed tax strategy. And the lending system, which was built decades ago for salaried employees with one employer and one W-2, does not know how to read you. So what does this mean for you? It means you're not unqualified. You are misqualified. You're being measured the wrong way. There is a solution, and it has been around for years. It is legitimate. It is widely used, and most people have never heard of it. It's called a bank statement loan. You will also hear it called a non-QM loan or a non-traditional loan. Three names, same idea. Think of it as a different set of glasses, same person, same income, but finally seen for what it really is. Here's the simple version. Instead of looking at your tax return, the lender looks at a window of your bank deposits over a set period of time. Those deposits get averaged out. A percentage is applied to account for the cost of running your business. What is left becomes your qualifying income. That is the what, the exact how, the time frame, the percentages, the program that fits you best. That's what we do for you when you call us. Let me give you an example. Say you deposit $20,000 a month into your business account. That's $240,000 a year flowing through the business. When that gets averaged and run through the program, the lender is suddenly seeing real six-figure cash flow instead of the $60,000 your tax return showed. Same person, same business, completely different outcome. And here's something most people don't realize. A lot of business owners using this program actually qualify for a larger loan than they would ever get through a traditional lender. In many cases, more than they would even want to spend from a budget standpoint. That's a very different conversation than being declined. That is a conversation about what fits your life, not what fits a form. Here's the part nobody talks about. This loan is often much simpler to apply for than a traditional loan. You're not digging through your taxes, your years of tax returns, K-1s, profit and loss statements, amended schedules, and letters from your CPA explaining one line on page 42. That's a headache for you to collect. That's a headache for you to supply. And honestly, for a lot of business professionals, that pile of paperwork is the reason they never applied in the first place. Bank statements, on the other hand, are usually very simple. You log into your bank's website, you download them, you send them over, that's it. For time-constrained business owners who would rather be running their company than assembling a paper mountain, a lot of them actually prefer this loan to a traditional loan. not just because it gets them qualified, because the process respects their time. And here's the part that really matters. A lot of brick and mortar banks do not offer this type of loan at all. So the loan officer at your local branch says you don't qualify. What they should really be saying is you don't qualify with us. That's a very different sentence. The one of them shuts the door on your dream. The other tells you to go find the right door. Too many people hear the first sentence and walk away forever. They never find out the second sentence was the truth. Now, let me address the pushbacks. Rates are typically slightly higher than a conventional loan that you didn't qualify for. Slightly, not significantly. Down payments can actually be in a similar range to what you would see on a traditional loan, depending on the program and your profile. Documentation is different, and for many of you, much easier. Remember, strategy beats rate always, because a rate on a loan you cannot get is just a number on a brochure. A slightly higher rate on a loan that actually puts you in the right home at the right time, in the right market, is how people build real wealth. Let me paint a picture. I recently worked through a scenario with a business owner. On paper, his tax return showed about $60,000 of income. In real life, his business deposited around $240,000 a year into his operating account. $20,000 a month. Traditional loan declined or severely limited as to the purchasing power. Non-traditional loan qualified comfortably based on real cash flow. And honestly, qualified for more home than he wanted to buy. Same person, same income, different set of glasses. And here's why this matters right now. More people are self-employed than ever before. The gig economy has exploded. Tax strategies have gotten more aggressive for good reason. But lending rules at a lot of banks have not kept up. The workforce changed. The rule book at a lot of brick and mortar lenders did not. So if you're being told you don't qualify, the question I want you to ask is not what's wrong with me. The question is, am I being evaluated the right way by the right lender? And to the realtors listening right now, if you're only writing offers for W-2 buyers, you are leaving deals on the table every week. There's an entire buyer pool of self-employed professionals, business owners, and 1099 earners who have been told no somewhere else and walked away thinking home ownership was out of reach. It isn't. They just need a lender who knows how to read the real story. 3 questions to ask yourself, to ask a buyer. 1, do you write off a significant portion of your income? 2, are your bank deposits higher than the income reported on your tax return? 3, have you ever been told you don't qualify even though your cash flow is strong? If the answer is yes to any of those questions, we should be having a conversation before you ever apply anywhere else. So here's what I want you to do. Before you assume you don't qualify, before you accept a no from somebody who was measuring you the wrong way, or from a lender who simply doesn't offer this kind of loan, let's look at how you actually earn income, not just how it was reported. Go to rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. It is the starting point for a real conversation about your income, your cash flow, and the strategy that fits your life, the strategy that fits the life you actually built. Income isn't the problem, reporting is. You are not unqualified, you are misqualified. And that's a fixable problem. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to Mortgage 101, brought to you by rsrlinks.com/keysteps, rsrlinks.com/keysteps.